This podcast is brought to you by Empor.top, the stories of top companies. Disclaimer: this AI-generated content is for informational purposes only and should not be considered as investment advice. Zoetis, from Pfizer Spinoff to animal health empire. Picture this. It's February 1st, 2013, and the trading floor at the New York Stock Exchange is buzzing with an energy not seen since Facebook's IPO 8 months earlier. At 9:30 a.m., a new ticker symbol flashes across screens worldwide: ZTS. Within minutes, shares surge 19% above their offering price, closing the day at $35.01. This wasn't another hot tech startup or biotech moonshot. This was Zoetis, a company most investors had never heard of, yet one that had been quietly operating for over 60 years, buried deep within Pfizer's corporate structure. Today, Zoetis stands as the undisputed leader in animal health, commanding a $75 billion market capitalization and generating $9.3 billion in annual revenue. The company that started as Pfizer's agricultural division in 1952 now operates in over 100 countries, employs nearly 14,000 people, and holds the number 1 or 2 market position in nearly every therapeutic category it competes in. Its products touch the lives of 8 species, from the family dog receiving Apoquel for allergies to the salmon in Norwegian fjords protected by pharmac vaccines. But here's the central question that makes this story so compelling. How does a corporate division, spun off primarily as a financial engineering move by its parent company, transform into one of the most successful spin-offs in pharmaceutical history? The answer involves a confluence of secular trends, strategic acquisitions, and perhaps most importantly, the recognition that the human-animal bond represents one of the most underappreciated growth drivers in healthcare. The Zoetis story unfolds across multiple acts. There's the 7-decade buildup within Pfizer where animal health grew from an accidental discovery to a $4 billion business. The dramatic 2013 spin-off that created immediate shareholder value. The aggressive M&A strategy that added diagnostics, nutrition, and aquaculture to the portfolio. And the current chapter, where Zoetis rides the twin waves of pet humanization in developed markets and protein demand growth in emerging economies. What makes this particularly relevant now? As investors search for defensive growth stories amid economic uncertainty, Zoetis offers a masterclass in building competitive moats in a specialized market. The company boasts 51% return on equity, generates $2.3 billion in free cash flow, and has delivered 8% compound annual growth since its IPO, all while operating in an industry that most generalist investors overlook. This is also a story about timing. Zoetis went public just as millennials began adopting pets in record numbers, treating them less like animals and more like family members. It expanded internationally as middle-class growth in China and Brazil drove protein consumption higher, and it pivoted into diagnostics right before COVID-19 accelerated the digitization of veterinary care. Over the next several hours, we'll dissect how Zoetis navigated each of these inflection points. We'll explore the strategic decisions that separated winners from losers in animal health. We'll examine the bear case, because yes, there are legitimate concerns about competition, regulation, and market saturation, and we'll extract the playbook lessons that apply far beyond this specific industry. Because ultimately, the Zoetis story isn't just about animal health. It's about how focused execution, strategic patience, and deep customer relationships can create extraordinary value, even when you're competing in a market that's a fraction the size of human pharmaceuticals. It's about recognizing that sometimes the best businesses are hiding in plain sight, buried within conglomerates, waiting for the right moment to be set free.
The year was 1949, and Pfizer scientist Benjamin Duggar was hunched over a microscope in Brooklyn, examining soil samples collected from around the world. At 77 years old, most would have been enjoying retirement, but Duggar had joined Pfizer just 5 years earlier with a mission: find new antibiotics in nature's pharmacy. What he discovered in a clump of Missouri dirt would accidentally launch one of the pharmaceutical industry's most successful diversifications. The golden-colored substance Duggar isolated was aureomycin, the first of the tetracycline antibiotics. But here's where the story takes an unexpected turn. While Pfizer's executives were celebrating aureomycin's potential in human medicine, farmers started reporting something remarkable. Chickens and pigs given feed, supplemented with fermentation byproducts from aureomycin production, were growing faster and staying healthier than their untreated counterparts. This wasn't planned. It was pure serendipity. By 1952, Pfizer made a decision that would seem radical today. It established a dedicated agriculture division and purchased 732 acres of Indiana farmland in Terre Haute to build what would become one of the world's most advanced animal health research facilities. Think about the audacity of this move. Pfizer was essentially betting that the same scientific rigor applied to human drugs could revolutionize animal care. The company recruited veterinarians, animal scientists, and formulators who understood that a 1,500-pound dairy cow metabolizes drugs very differently than a 10-pound cat. The Terre Haute facility became Pfizer's innovation laboratory for animal health. Scientists there didn't just test existing human drugs on animals. They developed entirely new compounds specifically for veterinary use. In 1973, they launched Banminth, an anti-parasitic that became the gold standard for deworming. By the 1980s, they had introduced Dectomax, which revolutionized parasite control in cattle. But the real transformation came in 1988, when Pfizer formally renamed the agriculture division to Pfizer Animal Health. This wasn't just cosmetic rebranding. It signaled a strategic shift from viewing animal products as agricultural inputs to recognizing them as healthcare solutions. The timing was prescient. The American pet industry was beginning its meteoric rise, driven by baby boomers who increasingly viewed pets as family members rather than property. The 1990s marked Pfizer Animal Health's golden age of innovation. In 1997, they launched Rimadyl, a non-steroidal anti-inflammatory that gave arthritic dogs a new lease on life. Pet owners who watched their elderly dogs struggle to climb stairs suddenly saw them playing fetch again. Rimadyl generated $100 million in its first year, unheard of for an animal drug at the time. Then came Revolution in 1999, a topical parasiticide that protected pets against fleas, heartworms, and ear mites with a single monthly application. The product's elegance was its simplicity. One drop on the back of the neck replaced multiple medications. Revolution quickly captured 20% of the global parasiticide market, generating over $300 million annually by 2005. The livestock side wasn't dormant either. In 2005, Pfizer launched Draxxin, an antibiotic for bovine respiratory disease that required just a single injection compared to multiple doses from competitors. Cattle ranchers, who measured success in pounds gained per day, saw Draxxin as revolutionary. The drug generated $100 million in sales within 2 years of launch. But here's what's fascinating about Pfizer's animal health strategy. They didn't just develop products organically. Starting in the late 1990s, they embarked on an acquisition spree that would make even today's aggressive acquirers blush. The logic was simple. Why build when you could buy established brands, manufacturing facilities, and customer relationships? The acquisition parade began modestly. In 1995, Pfizer bought SmithKline Beecham's animal health business for $1.45 billion, instantly adding vaccines and the Solvay parasiticide line. Then came the blockbuster deals. In 2003, Pfizer acquired Pharmacia, which included its animal health division. But the real prize came in 2009 when Pfizer bought Wyeth for $68 billion, a deal primarily focused on human pharmaceuticals, but which included Fort Dodge Animal Health, the world's leader in animal vaccines with $900 million in revenue. The Fort Dodge acquisition was transformative. It brought Pfizer the #1 position in animal vaccines globally, added 17 manufacturing sites, and, most importantly, provided deep expertise in biologics, an area where Pfizer Animal Health had been weak. The integration was complex, requiring the combination of different corporate cultures, regulatory approvals in dozens of countries, and the rationalization of overlapping product lines. By 2011, Pfizer Animal Health had become a behemoth. With $4.2 billion in revenue, it was larger than most standalone pharmaceutical companies. The division operated in 90 countries, employed 9,000 people, and maintained the industry's largest R&D organization with over 750 scientists. Its product portfolio spanned 8 major species and included 300 product lines. Yet within Pfizer's sprawling $67 billion empire, animal health was increasingly seen as a distraction. CEO Ian Redd, who took the helm in 2010, had a clear mandate: focus on innovative human pharmaceuticals with blockbuster potential. Animal health, despite its profitability and growth, didn't fit this vision. The business required different commercial models, selling to veterinarians rather than doctors, different regulatory pathways, USDA rather than FDA for many products, and different manufacturing standards. There was another factor at play. Pfizer's patent cliff was approaching fast. Lipitor, which generated $10 billion annually, would lose exclusivity in November 2011. The company needed to raise capital, reduce costs, and streamline operations. Animal health, valued by analysts at $15 to $20 billion, represented a massive unlocked asset on Pfizer's balance sheet. The stage was set for one of the most significant spin-offs in pharmaceutical history. But first, Pfizer's board had to answer a critical question. Would animal health be worth more as an independent company than as a division of Big Pharma? The answer would reshape an entire industry.
Ian Redd stood before Pfizer's board of directors in April 2011, just 4 months into his tenure as CEO, and delivered a message that would have been heresy under his predecessors. Pfizer needed to get smaller to get better. The sprawling conglomerate built through mega mergers, Warner Lambert, Pharmacia, Wyeth, had become unwieldy. Reed's solution was radical simplification. Every division would be evaluated on a single criterion. Did it enhance or distract from Pfizer's core mission of developing innovative human medicines? Animal health presented a particular conundrum. Unlike Pfizer's consumer products division, Centrum Vitamins, Chapstick, or its nutrition business, infant formula, animal health was actually performing exceptionally well. Revenues had grown from $3.6 billion in 2009 to $4.2 billion in 2011. Operating margins exceeded 30%. The division held leadership positions in most therapeutic categories. By any traditional metric, this was a business to keep and nurture. But Redd saw something others missed. Animal health's success was actually constrained by being part of Pfizer. Capital allocation decisions favored human pharmaceutical projects with billion-dollar potential over animal health products that might peak at $200 million. The division's executives spent enormous energy educating Pfizer's board about veterinary market dynamics rather than executing strategy. And perhaps most importantly, animal health couldn't pursue aggressive M&A without competing for resources against Pfizer's human pharma priorities. The internal debates were fierce. Juan Ramon Alay, who had led animal health since 2006, initially opposed the spinoff. He had spent 5 years integrating Fort Dodge, optimizing the manufacturing network, and building a unified culture. Why disrupt that momentum? But as Alay studied the proposition more carefully, he recognized an opportunity. As an independent company, animal health could make faster decisions, pursue targeted acquisitions, and, most importantly, tell its own story to investors who understood and valued the animal health market's unique dynamics. The naming process for the new company revealed just how serious Pfizer was about creating true independence. They hired Interbrand, the global branding consultancy, to develop an identity completely distinct from Pfizer. After evaluating 7,000 potential names, they settled on Zoetis, derived from zoetic, meaning pertaining to life. The name was tested across multiple languages and cultures to ensure it had no negative connotations. Even the pronunciation guide, Zoetis, was carefully crafted to be memorable yet professional. By July 2012, when Pfizer officially announced the spin-off plans, the financial logic had become irrefutable. Investment banks valued animal health at $15 to $20 billion. nearly 10% of Pfizer's entire market capitalization. The tax-free spin-off structure would allow Pfizer to distribute this value directly to shareholders without triggering a massive tax bill. Morgan Stanley and Bank of America Merrill Lynch were retained as lead underwriters, with J.P. Morgan adding additional firepower. The S-1 filing in August 2012 provided the first detailed look at what would become Zoetis. The numbers were impressive: $4.34 billion in 2012 revenue, up from $4.2 billion the prior year. The company operated in 3 segments: livestock, 56% of sales, companion animals, 42%, and performance products, 2%. Geographic diversity was strong, with 47% of revenues from outside the United States. The filing also revealed the depth of the product portfolio: 300 product lines sold in 120 countries, with no single product accounting for more than 7% of total revenue. But what really caught investors' attention was the market opportunity. The global animal health industry was valued at $22 billion and growing at 5 to 6% annually, faster than human pharmaceuticals. The drivers were compelling: rising protein consumption in emerging markets, increasing pet ownership in developed countries, and growing awareness of animal welfare. Unlike human pharma, animal health faced minimal generic competition due to different regulatory frameworks and the complexity of combination products. The pre-IPO roadshow in January 2013 was a masterclass in storytelling. Abaxis and his CFO, Paul Herendeen, crisscrossed the globe, conducting over 200 meetings with institutional investors. Their pitch was simple but powerful. Zoetis was the only pure-play animal health investment at scale, operating in a defensive growth market with high barriers to entry. They emphasized the subscription-like nature of many animal health products: monthly flea and tick preventatives, quarterly dewormers, annual vaccines, that created predictable revenue streams. One slide in particular resonated with investors. It showed the total addressable market expanding from $22 billion in 2012 to a projected $32 billion by 2020. The growth would come from 3 sources: volume growth driven by increasing animal populations, price increases as new innovations commanded premium pricing, and mix shift as emerging markets adopted the preventative care models common in developed countries. The regulatory pathway was complex but manageable. Because Zoetis would initially remain controlled by Pfizer through a dual-class share structure, it could complete the IPO without a full separation. Pfizer would own 414 million Class B shares carrying 10 votes each, while public investors would own Class A shares with 1 vote each. This structure would allow Pfizer to monetize part of its stake while maintaining control during the transition period. Behind the scenes, the operational separation was a Herculean effort. Zoetis needed to establish independent IT systems, separate its supply chain from Pfizer's network, and create standalone corporate functions. Over 400 legal entities across 70 countries had to be restructured. New enterprise resource planning systems were implemented. Transfer pricing agreements were negotiated for the transition period when Zoetis would still rely on some Pfizer manufacturing facilities. The cultural transformation was equally important. For decades, animal health employees had identified as Pfizer people. Now they needed to embrace a new identity as Zoetis colleagues. Abaxis launched a global communication campaign, conducting town halls in major sites, recording video messages for remote locations, and ensuring every employee understood both the rationale for independence and their role in the new company. As 2012 drew to a close, the pieces were in place. The IPO was scheduled for February 1st, 2013, with an initial price range of $22 to $25 per share. Demand from institutional investors was so strong that the range was raised to $25 to $26 just days before the offering. The stage was set for what would become the largest IPO by a U.S. company since Facebook. And unlike Facebook's troubled debut, this one would exceed all expectations.
At 6 a.m. on February 1, 2013, Juan Ramon Alex stood outside the New York Stock Exchange, watching the sunrise paint the limestone facade gold. In 3 hours, he would ring the opening bell as CEO of a newly independent Zoetis. The previous evening, the IPO had priced at $26 per share, the top of the raised range, valuing the company at $13 billion. The offering of 86.1 million shares would raise $2.24 billion, making it the largest U.S. IPO since Facebook's troubled debut 8 months earlier. Unlike Facebook's technical glitches and pricing controversies, Zoetis' debut was flawless. When trading opened at 9:30 a.m., shares immediately jumped to $31.01. By day's end, ZTS closed at $35.01, a 35% premium to the IPO price. The smooth execution vindicated the months of preparation and sent a clear message. The market believed in the animal health story. The investor base that emerged was telling. Long-only fundamental funds like Vanguard, BlackRock, and Fidelity took major positions. But more interesting were the specialists. Healthcare-focused funds that had never been able to invest in animal health at scale were finally given their opportunity. The geographic distribution was also notable. 40% of the shares went to international investors, reflecting Zoetis' global footprint. Pfizer's retention of 80.1% ownership through 414 million Class B shares created an unusual dynamic. While Zoetis was now public, Pfizer still controlled all major decisions through its super voting shares. This wasn't necessarily negative. It provided stability during the transition and assured investors that Pfizer wouldn't dump shares and crash the stock price. But it also meant Zoetis couldn't pursue major acquisitions or strategic changes without Pfizer's approval. The first earnings call as a public company on May 7, 2013, set the tone for what investors could expect. Alex and CFO Paul Herendeen delivered first-quarter results that beat expectations. $1.1 billion in revenue, up 4% operationally with companion animal growing 11% and livestock flat. But more importantly, they articulated a clear strategy: accelerate innovation, expand in emerging markets, and maintain pricing discipline. Just 2 weeks later, Pfizer announced it would dramatically accelerate its exit. Rather than slowly selling shares over several years, Pfizer would dispose of its entire stake through an exchange offer. Pfizer shareholders could swap their Pfizer shares for Zoetis shares at a 7% discount to market price. The structure was tax-efficient for both Pfizer and its shareholders, while allowing Zoetis to achieve full independence much faster than originally planned. The exchange offer, completed on June 24, 2013, was massively oversubscribed. Pfizer shareholders tendered $35 billion worth of Pfizer stock to receive Zoetis shares, far exceeding the $11.4 billion available. The proration meant investors received 1 Zoetis share for every 20 Pfizer shares tendered, but the message was clear. Investors wanted exposure to animal health. With full independence achieved just 5 months after the IPO, Zoetis could finally operate without constraints. The first major decision was symbolic but important: establishing a new headquarters. Rather than remain in Pfizer's shadow in New York, Zoetis chose Parsippany, New Jersey, taking over a campus that provided room for expansion and a distinct identity. The operational separation from Pfizer was complex and costly. Transition service agreements, TSAs, covered everything from IT systems to manufacturing. Zoetis paid Pfizer approximately $200 million annually for these services during the transition period, but Alex viewed this as an investment in independence. Every function that moved in-house, whether payroll processing or regulatory submissions, represented a step towards self-determination. The early independent operations revealed both opportunities and challenges. On the positive side, decision-making accelerated dramatically. Product launches that might have taken months of corporate approvals at Pfizer could now be greenlit in weeks. The R&D organization, freed from competing with human pharma projects for resources, increased its productivity. The commercial organization, no longer bound by Pfizer's global contracts and pricing strategies, could negotiate country-by-country deals optimized for local markets. But independence also exposed vulnerabilities. Zoetis's IT infrastructure, hastily separated from Pfizer's systems, struggled with integration issues. The company lacked the purchasing power of a $200 billion pharmaceutical giant when negotiating with suppliers. And perhaps most challenging, Zoetis had to build credibility with regulators who had previously dealt with Pfizer's extensive government affairs apparatus. The financial markets, however, remained enthusiastic. By December 2013, Zoetis stock had risen to $35.50, a 37% gain from the IPO price. The company delivered on its financial commitments. Full-year 2013 revenue of $4.56 billion, adjusted net income of $821 million, and free cash flow of $777 million. The board authorized a $500 million share repurchase program, signaling confidence in the business model. One moment from late 2013 captured the transformation. At the J.P. Morgan Healthcare Conference in January 2014, Alex was asked how it felt to run an independent Zoetis versus the old Pfizer Animal Health. His response was telling. At Pfizer, we were successful despite the system. At Zoetis, we're successful because of the system we're building. The company that had been buried within a pharmaceutical giant for 60 years was finally free to chart its own course. The first year of independence also revealed Zoetis's strategic priorities. The company announced increased R&D investment, targeting 7% of revenue compared to the 5 to 6% typical of animal health competitors. It established innovation centers in Kalamazoo, Michigan, and Dublin, Ireland. Most significantly, it began evaluating acquisition targets, something that would have required extensive Pfizer approvals just months earlier. As 2013 drew to a close, one metric stood out. Employee engagement scores had increased by 15 percentage points since independence. The 9,000 Zoetis colleagues worldwide finally felt they owned their destiny. This cultural transformation, perhaps more than any financial metric, suggested that the spin-off had succeeded in creating something greater than the sum of its parts.
The email that landed in Juan Ramon Aleix's inbox in January 2014 was brief but momentous. Apoquel, approved by FDA, launch immediately. After 7 years and $100 million in development costs, Zoetis had created what would become the fastest-growing product in animal health history. Within 18 months, Apoquel would generate $150 million in revenue. By 2018, it would exceed $400 million annually. But the real story of Apoquel wasn't just its commercial success. It was how the product redefined what pet owners would pay for quality of life. Apoquel targeted canine atopic dermatitis, essentially allergic itching in dogs. Previous treatments relied on steroids with significant side effects or antihistamines with limited efficacy. Apoquel, a Janus kinase inhibitor, offered rapid relief. Most dogs stopped scratching within 4 hours. Without the side effects of steroids, veterinarians who had struggled for decades to manage itchy dogs suddenly had a solution that actually worked. The launch, however, nearly became a victim of its own success. Demand so dramatically exceeded supply that Zoetis had to implement allocation limits, restricting veterinarians to ordering just 2 bottles per month. Online forums filled with desperate pet owners seeking Apoquel for their suffering dogs. The shortage lasted 8 months until Zoetis could scale manufacturing at its Lincoln, Nebraska facility. This supply crisis, while painful, actually built pent-up demand that drove explosive growth once inventory normalized. But Alex knew that organic innovation alone wouldn't maintain Zoetis's market leadership. In July 2014, the company announced its first significant acquisition as an independent entity, Abbott's animal health business, for $255 million. While small, the deal was strategically important. It brought established brands in pain management and anesthesia, but more importantly, it proved Zoetis could execute M&A without Pfizer's oversight. The Abbott integration became a template for future acquisitions. Rather than immediately rebrand products or eliminate staff, Zoetis maintained continuity with customers while gradually integrating back-end operations. The sales force was retained but retrained on Zoetis's broader portfolio, effectively turning every Abbott representative into a multi-product specialist. Then came an unexpected activist investor. In November 2014, Bill Ackman's Pershing Square disclosed an 8.5% stake in Zoetis, worth approximately $1.2 billion. Ackman's thesis was simple. Zoetis was dramatically under-earning its potential. Operating margins of 28% lagged human pharma companies despite similar business models. The company's tax rate of 29% was too high for a global business, and management was too conservative in deploying the company's strong cash generation. Ackman's 88-page presentation, delivered to investors in December 2014, outlined a path to 35% EBITDA margins and $2 billion in annual free cash flow by 2017. His proposals included aggressive cost-cutting, supply chain optimization, tax inversions, and accelerated share buybacks. While management publicly welcomed constructive dialogue, privately they worried about disrupting the cultural transformation still underway from the Pfizer separation. The Pershing Square investment catalyzed important changes without the acrimony typical of activist situations. Zoetis accelerated its operational excellence program, targeting $300 million in cost savings by 2017. The company optimized its manufacturing network, closing older facilities and investing in automation. Most importantly, it adopted a more aggressive capital allocation strategy, increasing the dividend and expanding share repurchases. The year 2015 marked Zoetis's bold entry into aquaculture with the $765 million acquisition of Pharmac, a Norwegian company specializing in fish vaccines. The strategic logic was compelling. Aquaculture was the fastest-growing segment of animal protein production, expanding at 8% annually as wild fish stocks declined. Pharmac held 30% market share in salmon vaccines and had developed innovative DNA vaccines that provided lifetime immunity with a single injection. The Pharmac deal also revealed Zoetis's global ambitions. Norway and Chile, the world's largest salmon producers, became strategic priorities. The company established research facilities in Bergen and Puerto Montt, hiring marine biologists and fish health specialists. Within 2 years, Pharmac's DNA vaccine technology was adapted for warm water species like tilapia and shrimp, opening massive markets in Asia. Innovation accelerated across the portfolio. In December 2016, Zoetis received conditional FDA approval for Cytopoint, a monoclonal antibody injection for atopic dermatitis in dogs. Unlike daily Apoquel tablets, Cytopoint required just monthly injections administered by veterinarians. This created a new revenue model, recurring veterinary visits rather than prescription refills. That strengthened Zoetis's relationship with its primary customers. The development of Cytopoint showcased Zoetis's scientific capabilities. The company had essentially created a biological drug for dogs, requiring specialized manufacturing in mammalian cell culture and complex purification processes. The $100 million investment in biologics, manufacturing at its Lincoln, Nebraska facility, positioned Zoetis as the only animal health company with full biological development and production capabilities. The 2017 acquisition of NexVet for an undisclosed sum, estimated at $85 million, might have seemed redundant given Cytopoint's success, but it revealed sophisticated portfolio management. NexVet had developed a similar monoclonal antibody for atopic dermatitis that was further along in European regulatory approval. Rather than compete, Zoetis bought NexVet, accelerated European launch, and integrated their antibody platform for future products. By 2017, the transformation was evident in the numbers. Revenue reached $5.3 billion, up from $4.6 billion at independence. Companion animal sales had grown to 48% of total revenue from 42% in 2013. Operating margins expanded to 31.5% from 25% at the IPO. The company generated $1.2 billion in free cash flow, validating Ackman's thesis even as Pershing Square quietly exited its position with a 35% gain. The product portfolio had also evolved dramatically. In 2013, Zoetis essentially sold the same products Pfizer Animal Health had developed. By 2018, new products launched post-independence generated over $800 million in annual revenue. The innovation pipeline contained 40 major projects, including novel parasiticides, cancer therapeutics, and pain medications that would have been impossible within Pfizer's human-focused R&D structure. But perhaps the most important development was cultural. The annual employee engagement survey showed 87% of colleagues were proud to work for Zoetis, up from 72% in 2013. The company had successfully transformed from a corporate division to an independent innovator. This cultural capital would prove essential for the next phase of growth, a $2 billion acquisition that would fundamentally reshape Zoetis's business model.
The conference room at Zoetis's Parsippany headquarters was tense on March 15, 2018. Juan Ramon Alaix and his executive team were about to make the largest bet in the company's brief independent history, acquiring Abaxis, a veterinary diagnostics company, for $2 billion in cash. The price represented a 44% premium to Abaxis's closing stock price and valued the company at 38 times trailing earnings. Several board members questioned whether Zoetis was overpaying for entry into an unfamiliar market. Alex's response was forceful. "We're not buying a diagnostics company. We're buying the future of veterinary medicine." He explained that diagnostics represented the fastest-growing segment in animal health, expanding at 10% annually compared to 6% for therapeutics. More importantly, diagnostics created a platform for precision medicine in veterinary care, enabling earlier intervention and better outcomes. The board approved the deal unanimously. Abaxis wasn't just any diagnostics company. Founded in 1989 by Russian immigrant Vladimir Ostoich, the company had pioneered point-of-care testing for veterinary clinics. Their VetScan platform could run complete blood counts, chemistry panels, and electrolyte analyses in minutes using just drops of blood. This transformed veterinary practice. Rather than sending samples to reference labs and waiting days for results, veterinarians could diagnose and treat patients during a single visit. The technology behind VetScan was remarkably sophisticated. Each test used a plastic rotor containing microscopically precise channels and chambers. When spun at high speed, centrifugal and capillary forces separated blood components and mixed them with freeze-dried reagents. Optical sensors measured the resulting chemical reactions, generating results comparable to large reference lab analyzers. The elegance was that all this complexity was hidden behind a simple user interface that any veterinary technician could operate. But Abaxis brought more than just instruments. The company had built an installed base of 30,000 analyzers globally, each generating recurring revenue through consumable rotors that cost $15 to $25 per test. This razor and blades model meant that every analyzer placement created an annuity stream. Veterinary clinics that adopted VetScan typically increased their diagnostic testing by 40%, as the convenience of immediate results encouraged more comprehensive workups. The integration challenged Zoetis in unexpected ways. Selling diagnostics required different capabilities than pharmaceuticals. Rather than detailing drugs to veterinarians, sales representatives needed to understand practice workflow, demonstrate ROI calculations, and provide technical support. Zoetis established a dedicated diagnostics commercial team, recruiting from medical device companies rather than pharmaceutical backgrounds. The market opportunity justified the investment. The global veterinary diagnostics market was valued at $3 billion in 2018 and projected to reach $5 billion by 2025. Growth drivers included aging pet populations requiring more frequent testing, emerging diseases demanding rapid identification, and pet owners willing to pay for advanced care. In human medicine, diagnostics influenced 70% of treatment decisions. In veterinary medicine, that figure was just 30%, suggesting massive expansion potential. Zoetis immediately began leveraging synergies between diagnostics and therapeutics. When veterinarians diagnosed chronic kidney disease using VetScan, Zoetis representatives could recommend appropriate therapeutic interventions from their pharmaceutical portfolio. This consultative selling approach deepened customer relationships and increased share of wallet. Clinics that adopted both Zoetis diagnostics and therapeutics increased their purchases by 25% on average. The company also invested heavily in expanding Abaxis' product line. New rotors were developed for specialized tests, thyroid panels for hyperthyroid cats, phenobarbital monitoring for epileptic dogs, and progesterone testing for breeding management. Each new test expanded the addressable market and increased utilization of existing analyzers. By 2019, the average vet scan generated $8,000 in annual consumable revenue, up from $6,000 at acquisition. Reference laboratory services became the next frontier. While point-of-care testing handled routine diagnostics, complex cases required specialized tests like PCR pathogen identification or histopathology. In 2019, Zoetis acquired Phoenix Lab, a reference laboratory specializing in exotic animal diagnostics. This was followed by ZN Labs in 2020, focused on oncology and genetic testing. The strategy was clear: own the entire diagnostic value chain from simple in-clinic tests to complex reference lab analyses. The diagnostic expansion also enabled new business models. Zoetis launched VetScan Imagist, an AI-powered microscopy system that could identify parasites, bacteria, and cellular abnormalities. The system connected to cloud-based algorithms that improved with every sample analyzed. Veterinarians paid per-test fees for the AI analysis, creating a software-as-a-service revenue stream with 80% gross margins. Data became an increasingly valuable asset. Every diagnostic test generated information about disease prevalence, treatment outcomes, and population health trends. Zoetis established a data analytics division to mine these insights, providing veterinarians with benchmarking reports and pharmaceutical companies with real-world evidence for drug development. While careful to maintain privacy and comply with regulations, Zoetis was building one of the most comprehensive animal health databases in the world. The financial impact was substantial. Diagnostics revenue grew from essentially zero in 2017 to $500 million by 2020. More importantly, diagnostics pulled through pharmaceutical sales. Clinics using Zoetis diagnostics purchased 30% more Zoetis therapeutics than those using competitor systems. The combination of diagnostics and therapeutics also increased customer stickiness. Switching costs rose significantly when practices had integrated both product lines into their workflow. By late 2018, even the skeptics acknowledged the Abaxis acquisition's strategic brilliance. The deal had transformed Zoetis from a pharmaceutical company into a comprehensive animal health solutions provider. The company could now participate in the full continuum of care: prevention through vaccines, diagnosis through testing, treatment through therapeutics, and monitoring through follow-up diagnostics. But the diagnostics pivot also revealed a larger ambition. In his 2018 annual letter, Alex wrote, "The future of animal health isn't about selling products. It's about delivering outcomes. Diagnostics allow us to measure those outcomes objectively, creating value for veterinarians, pet owners, and animals." This philosophy would guide the company's next phase of growth, even as leadership changed hands.
Kristen Peck stood at the podium of the Marriott Marquis in Times Square on January 1, 2020, addressing 300 Zoetis leaders from around the world. As the newly appointed CEO, the first woman to lead a major animal health company. She inherited a business generating $6.3 billion in revenue across 100 countries. But Peck saw opportunity where others saw maturity. "We've been thinking too small," she declared. "It's time to reimagine what Zoetis can become globally." Peck's background uniquely prepared her for this moment. Having joined Pfizer in 2004 and led Zoetis' U.S. operations since the spinoff, she understood both the company's heritage and its potential. Her strategic insight was that Zoetis had been managing geography like a pharmaceutical company, focusing on developed markets with established regulatory frameworks. But animal health's growth would come from emerging markets where protein consumption was exploding and pet ownership was just beginning its ascent. China exemplified this opportunity, with 100 million pet dogs and 60 million cats. Numbers growing 20% annually, China had become the world's second-largest pet market. yet per-pet spending was just $50 annually compared to $500 in the United States. Zoetis had operated in China since 1995, but treated it as a livestock market with a small companion animal adjunct. Peck flipped this model, establishing a dedicated China companion animal division with local leadership and autonomous decision-making. The China strategy required cultural adaptation. Chinese pet owners, predominantly millennials and Gen Z, approached pet care differently than Western counterparts. They preferred traditional Chinese medicine alongside Western therapeutics, valued preventive care over treatment, and trusted key opinion leaders, KOLs, on social media more than veterinarians. Zoetis partnered with pet influencers on Weibo and Douyin, sponsored pet reality shows, and developed combination products incorporating traditional herbs with modern pharmaceuticals. Brazil presented different challenges and opportunities. As the world's largest exporter of beef and second largest producer of poultry, Brazil's livestock industry was massive but fragmented. Zoetis operated through distributors who controlled customer relationships and captured margin. Peck authorized a bold move, acquiring key distributors and establishing direct sales to large integrators. The strategy was risky. Distributors could retaliate by pushing competitor products, but necessary for long-term growth. The Brazilian transformation succeeded beyond expectations. Direct relationships with companies like JBS and BRF allowed Zoetis to implement comprehensive health programs rather than just sell individual products. Revenue per customer increased 40% as Zoetis became a health consultant rather than a supplier. The company also introduced innovative financing, allowing producers to pay for vaccines and antibiotics after animals were sold, aligning Zoetis' success with customer outcomes. India became the next frontier. With 500 million livestock and a rapidly growing middle class adopting pets, India offered enormous potential, complicated by regulatory complexity. Each of India's 28 states had different registration requirements, distribution regulations, and pricing controls. Rather than navigate this maze alone, Zoetis formed a joint venture with Hester Biosciences, a local vaccine manufacturer with deep regulatory expertise and manufacturing capabilities. But geographic expansion went beyond emerging markets. In developed markets, Zoetis pursued specialized segments previously considered too small. The equine market, valued at $2 billion globally, had been dominated by small specialized companies. Zoetis acquired Platinum Performance in 2019, a leader in equine nutrition and supplements, instantly becoming a major player in horse health. The acquisition brought proprietary formulations, endorsements from Olympic riders, and distribution through veterinary channels. Then came COVID-19, arriving just months into Peck's tenure. The pandemic could have derailed the geographic expansion, but instead accelerated it. As global supply chains fractured, Zoetis' distributed manufacturing network, 24 sites across 6 continents, proved remarkably resilient. When India banned exports, the company's Thailand facility ramped production. When European borders closed, local manufacturing maintained supply. The pandemic also triggered unprecedented pet adoption. Animal shelters emptied as people working from home sought companionship. The pandemic puppy phenomenon drove 20% growth in companion animal products in 2020, far exceeding projections. But Peck recognized this wasn't just a temporary boom. Survey data showed 90% of new pet owners intended to maintain or increase spending post-pandemic, having formed deep bonds during lockdown. Zoetis capitalized on this trend by accelerating digital initiatives. The company launched MyPet Pro, a platform connecting veterinarians with pet owners for telemedicine consultations, prescription management, and appointment scheduling. While regulatory restrictions limited telemedicine's scope, the platform strengthened the veterinarian-client relationship and created switching costs for practices considering alternative suppliers. The year 2021 brought breakthrough innovation with the approval of Librela and Silencia, monoclonal antibodies for osteoarthritis in dogs and cats, respectively. These weren't just new products. They represented a new therapeutic category in veterinary medicine. Osteoarthritis affected 40% of dogs and 60% of cats over age 6, but existing treatments had significant limitations. The monoclonal antibodies offered monthly injections providing sustained pain relief without the side effects of NSAIDs. The launch strategy for Librela and Silencia demonstrated sophisticated market development. Rather than traditional detailing, Zoetis created pain clinics, where veterinarians could learn to recognize and quantify osteoarthritis. The company developed owner education materials explaining that decreased activity in older pets wasn't normal aging, but treatable pain. Within 6 months, the products generated $100 million in revenue, with adoption accelerating. Geographic expansion also meant acquisitions in new territories. The 2020 purchase of FishVet Group enhanced Pharmacue's presence in Scotland and Ireland's salmon farming industries. The 2021 acquisition of Ethos Diagnostic Science, though technically U.S.-based, provided reference laboratory capabilities supporting international expansion. Each deal was relatively small, under $200 million, but strategically important for entering new markets or segments. By the end of 2021, the transformation was remarkable. International revenue had grown to 53% of total sales from 47% at independence. Emerging markets contributed $1.2 billion in revenue, growing at 15% annually. China alone generated $400 million, making it Zoetis' third largest market after the U.S. and Brazil. The company operated in 100 countries with direct sales in 45, up from 30 in 2013. But perhaps most impressively, Zoetis had maintained market leadership while expanding geographically. The company held the number 1 or 2 position in 85% of the markets where it competed. In companion animal therapeutics, Zoetis commanded 25% global market share, nearly double its nearest competitor. This dominance created a virtuous cycle. Market leadership drove higher margins, funding R&D investment, creating innovative products, reinforcing market leadership. As 2021 closed with revenue reaching $7.8 billion, Peck reflected on the journey in her annual letter. Geographic expansion isn't about planting flags. It's about understanding local needs, building local capabilities, and delivering local value. When we do that successfully, global growth follows naturally. The company that had once been U.S.-centric was now truly global, positioned to capture growth wherever it emerged.
The morning sun catches the glass facade of Zoetis' new innovation center in Parsippany, New Jersey. A $120 million, testament to how far the company has come since independence. Inside, Kristen Peck reviews the latest quarterly results with her executive team. Revenue hit $9.3 billion in 2024, a milestone that seemed impossible when the company spun off from Pfizer just over a decade ago. The company now employs approximately 13,800 people worldwide, nearly 50% more than at independence. But what's most remarkable isn't the size. It's the transformation in strategic focus. We're not just an animal health company anymore, Peck tells her team. We're a precision animal care company. The distinction matters. Traditional animal health focused on treating sick animals. Zoetis' vision encompasses prevention, diagnosis, treatment, and monitoring. The full continuum of care. This strategic evolution drives everything from R&D investments to acquisition strategy to commercial execution. The 2024 performance validates this approach. The U.S. business achieved 11% revenue growth, driven by what Peck calls the 3 pillars of growth: innovation adoption, market expansion, and price realization. The companion animal segment, now representing over 60% of U.S. revenue, grew 14% as pet owners increasingly viewed veterinary care as essential rather than discretionary. Even more impressive, this growth came despite tough comparisons to the pandemic-era boom, proving the secular trend of pet humanization has legs beyond COVID-19. International markets delivered equally strong results. In the third quarter alone, revenue reached $2.4 billion with 14% operational growth, demonstrating the payoff from years of geographic expansion. China's companion animal business grew over 30%. Brazil's livestock segment expanded 15%, and even mature European markets delivered high single-digit growth. The company's ability to grow across diverse geographies and species provides resilience that pure-play competitors lack. The product portfolio performance tells a story of successful innovation. The Simparica franchise, Zoetis' triple combination parasiticide, has become a blockbuster, generating over $1.5 billion annually and still growing at double-digit rates. Apoquel and Cytopoint, the dermatology franchise, surpassed $800 million in combined sales. The newly launched Librela and Solensia for osteoarthritis in pets are tracking ahead of launch expectations, with veterinarians reporting unprecedented owner satisfaction scores. But perhaps the most underappreciated aspect of Zoetis' current position is its financial profile. Free cash flow reached $2.299 billion in 2024, a 41.48% increase from 2023. Return on equity stands at 52.77%. Extraordinary for a company that isn't asset-light software but rather operates manufacturing facilities, maintains inventory, and conducts extensive R&D. Gross margins of 71.47% and operating margins of 37.52% rival the best pharmaceutical companies despite operating in markets with lower absolute pricing. The capital allocation strategy reflects both confidence and discipline. The company returned $2.65 billion to shareholders in 2024 through dividends and buybacks, while simultaneously investing over $700 million in R&D, maintaining the 7 to 8% of revenue R&D investment that distinguishes Zoetis from competitors. The balance sheet remains conservative with net debt of approximately $5.4 billion, providing flexibility for opportunistic acquisitions without compromising the investment-grade credit rating. Digital transformation, barely on the radar 5 years ago, now represents a critical growth driver. The Zoetis digital ecosystem connects over 15,000 veterinary clinics globally, providing everything from inventory management to treatment protocols to continuing education. The platform generates valuable data on disease prevalence, treatment outcomes, and emerging health threats. While Zoetis doesn't break out digital revenues, industry analysts estimate the ecosystem contributes 2 to 3 percentage points to annual growth through improved customer retention and share of wallet expansion. The diagnostics business, built through the Abaxis acquisition and subsequent bolt-ons, has exceeded expectations. Diagnostics revenue approached $600 million in 2024, with the installed base of analyzers growing 15% annually. More importantly, consumable revenue per analyzer continues to increase as veterinarians run more comprehensive panels. The reference lab network, while still subscale compared to IDXX, provides strategic value by offering integrated diagnostic solutions that pull through pharmaceutical sales. Looking ahead to 2025, management's guidance reflects continued confidence. Revenue is projected between $9.225 billion to $9.375 billion, with organic operational growth of 6% to 8%. This guidance assumes no major economic disruption, but also doesn't count on another pandemic-style demand surge. The growth will come from multiple sources: continued Simparica share gains, Librela and Solensia adoption acceleration, China companion animal expansion, and U.S. price increases in line with inflation. The innovation pipeline remains robust with over 40 major projects in development. The company is investing heavily in monoclonal antibodies, having seen the success of Cytopoint, Librela, and Solensia. Gene therapy for inherited diseases in dogs is in early development. Digital biomarkers using wearable devices to detect illness before clinical signs appear are being validated. And the company continues to expand its vaccine portfolio, particularly in aquaculture, where disease prevention is critical for sustainable production. Sustainability has evolved from corporate rhetoric to business strategy. Zoetis' products help reduce the environmental footprint of animal protein production. Healthier animals require less feed, water, and land to produce the same amount of protein. The company's antibiotics help reduce mortality, its vaccines prevent disease outbreaks, and its reproductive technologies improve breeding efficiency. By 2030, Zoetis aims to reduce its own carbon footprint by 50% while helping customers reduce theirs through innovative products. The competitive landscape continues to evolve. Merck Animal Health remains formidable in livestock vaccines and parasiticides. Elanco, burdened by debt from its Bayer acquisition, is retrenching but still holds strong positions in key categories. Boehringer Ingelheim continues to invest aggressively in R&D, and new entrants, particularly from China, are emerging with biosimilar strategies. Yet Zoetis's scale, breadth, and innovation engine provide sustainable competitive advantages. Perhaps most tellingly, employee engagement scores reached all-time highs in 2024, with 91% of colleagues saying they're proud to work for Zoetis. This cultural strength translates into commercial execution, as the company consistently wins competitive situations through superior customer relationships and technical support. The Salesforce turnover rate of less than 5% compares favorably to the 15 to 20% industry average, providing continuity that customers value. As 2025 begins, Zoetis stands at an inflection point. The company has successfully navigated the transition from Pfizer division to independent leader. It has expanded geographically, therapeutically, and technologically. It has delivered consistent growth while maintaining industry-leading profitability. The question now isn't whether Zoetis can succeed. It's how much value the company can create as the animal health industry continues its transformation. We've built something special here, Peck reflects in a recent investor call. But we're just getting started. The convergence of human and animal health, the digitization of veterinary medicine, the growing recognition of the human-animal bond. These trends will drive growth for decades. Our job is to stay ahead of them. Based on the company's track record and current trajectory, that's exactly what investors should expect.
The Pfizer conference room in December 2011 was thick with tension. Ian Redd's team was presenting the animal health spinoff proposal to the board, and Director James Kiltz, former CEO of Gillette, posed the critical question, what makes you think animal health will be worth more independent than as part of Pfizer? The head of strategy pulled up a slide showing successful pharma spinoffs. Abbott's AbbVie, Merck's Organon, Bristol-Myers Squibb's Mead Johnson. Everyone, he said, traded at a higher multiple post-spin than their parent company's blended multiple. The market rewards focus. This insight, that focused pure plays command premium valuations, represents the first and perhaps most important lesson from the Zoetis story. When Zoetis IPO'd at 20 times earnings, Pfizer traded at just 12 times. Today, Zoetis trades at 25 times forward earnings while large pharma multiples remain stuck in the mid-teens. The multiple expansion alone created over $30 billion in shareholder value. For investors, the lesson is clear. Complexity discounts are real, and spin-offs that unlock focused stories often outperform. But the spin-off playbook goes deeper than just multiple arbitrage. Zoetis demonstrates that the best spin-offs combine three elements: a coherent business that can stand alone, a management team that thinks like owners, and a market opportunity that's underappreciated by the parent's investor base. Animal Health checked all three boxes. It had distinct customers, veterinarians versus doctors, different regulatory pathways, USDA versus FDA, and unique market dynamics, no pharmacy benefit managers or generic cliffs. These differences, viewed as complications within Pfizer, became competitive advantages for independent Zoetis. The second major lesson involves building moats in specialized markets. Zoetis's 25% market share in companion animal health might seem modest compared to big tech monopolies, but in the fragmented animal health industry, it's dominant. The company achieved this through multiple reinforcing moats. Brand loyalty runs deep. Veterinarians who trust Apoquel for dermatology are more likely to prescribe Simparica for parasites. Switching costs are high. Changing a clinic's preferred parasite prevention protocol requires retraining staff and re-educating clients. And the regulatory barriers are formidable. Developing a new animal drug requires 7 to 10 years and $100 million, deterring new entrants. The R&D strategy offers another crucial lesson. In specialized markets, consistent innovation investment beats sporadic moonshots. Zoetis invests 7 to 8% of revenue in R&D annually. Not exceptional by pharma standards, but remarkably consistent. Rather than betting everything on one breakthrough drug, the company pursues a portfolio approach. Incremental improvements to existing products, line extensions into new species, and selective bets on new platforms like monoclonal antibodies. This steady innovation creates a compound effect. Each successful launch strengthens customer relationships and funds the next wave of development. Capital allocation at Zoetis provides a masterclass in balancing growth and returns. The company generates enormous cash flow, $2.3 billion in free cash flow in 2024, but resists the temptation to pursue transformative megadeals. Instead, management follows a disciplined hierarchy. First, invest in organic growth through R&D and commercial expansion. Second, pursue bolt-on acquisitions that fill portfolio gaps or add capabilities. Third, return excess capital to shareholders. This discipline has delivered 52.77% return on equity while maintaining a conservative balance sheet. The M&A strategy deserves particular attention. Unlike many successful companies that eventually succumb to empire building, Zoetis has maintained remarkable acquisition discipline. Each deal, from Abaxis' diagnostics to Pharmac's fish vaccines, had clear strategic logic and achievable synergies. The company walks away from auctions when prices get frothy, as it did with several veterinary hospital chains, and integration is prioritized over new deals. Zoetis typically waits 12 to 18 months between significant acquisitions to ensure proper absorption. Geographic diversification offers another lesson, particularly relevant in an increasingly fragmented global economy. Zoetis generates 53% of revenue internationally across 100 countries. This isn't just about risk mitigation, though that matters when U.S. livestock markets soften or European regulations tighten. It's about capturing growth wherever it emerges. When China's pet population exploded, Zoetis was already there. When Brazil's protein exports boomed, Zoetis had the local presence to capitalize. This geographic diversity requires patience and investment, but provides resilience that domestic-focused competitors lack. The power of secular trends represents perhaps the most important investing lesson. Zoetis benefits from two unstoppable forces: the humanization of pets in developed markets and rising protein consumption in emerging markets. These aren't cyclical trends subject to economic whims. They're fundamental shifts in how humanity relates to animals. Pet ownership correlates with GDP per capita almost perfectly. Protein consumption rises predictably with income growth. By aligning with these secular trends, Zoetis enjoys a growth tailwind that can overcome periodic headwinds. Customer concentration, or lack thereof, provides another key insight. No single customer represents more than 2% of Zoetis' revenue. The company serves 50,000 veterinary clinics, millions of livestock producers, and hundreds of millions of pet owners. This diversification means no single customer can dictate terms, enabling Zoetis to maintain pricing power. Compare this to companies dependent on a few major retailers or government contracts, and the advantage becomes clear. The regulatory moat deserves special mention. Animal health regulations are complex but rational. Products must be safe and effective, but the approval process is faster and cheaper than human drugs. This creates a sweet spot. Barriers high enough to deter casual entrants, but not so high that innovation becomes impossible. Zoetis' regulatory expertise, built over 70 years, allows it to navigate this complexity efficiently. The company maintains regulatory teams in every major market, understanding local requirements and maintaining relationships with regulators. Pricing power in animal health offers fascinating lessons about value perception. Pet owners spending $100 monthly on Apoquel and Cytopoint aren't comparing prices to human drugs. They're comparing to the emotional value of their pet's comfort. This emotional component allows premium pricing for innovative products. In livestock, the ROI calculation is purely economic, but equally favorable. If Draxxin prevents respiratory disease that would cost $500 per animal, farmers gladly pay $50 for prevention. The Zoetis story also demonstrates the importance of culture in sustaining competitive advantage. The company's employee engagement scores consistently rank in the top quartile across industries. This isn't touchy-feely corporate speak. Engaged employees drive commercial execution. They stay longer, reducing training costs and preserving customer relationships. They innovate more, generating ideas that become new products, and they recruit talented colleagues, creating a virtuous cycle of human capital accumulation. Finally, the Zoetis playbook offers a crucial lesson about timing. The company went public just as multiple trends converged: millennials adopting pets, China's middle class emerging, and biotechnology becoming accessible for animal applications. But this wasn't luck. Pfizer Animal Health had positioned for these trends through decades of investment. The lesson for investors: identify secular trends early, position accordingly, and have patience for the convergence that creates extraordinary returns. For other potential spin-offs, Zoetis provides a template. Build distinctive capabilities during the corporate incubation period. Develop a leadership team that can operate independently. Create a compelling equity story that resonates with specialist investors. Execute the separation cleanly without disrupting operations. And most importantly, use independence to accelerate strategy rather than just maintain the status quo. The playbook extends to capital market strategy. Zoetis carefully cultivated relationships with specialist healthcare investors who understood the animal health opportunity. Management provided consistent, achievable guidance and then delivered on promises. The company educated generalist investors about industry dynamics without overselling the story. This patient approach built credibility that compounds over time. When Zoetis provides guidance now, the market believes it.
The bull case: a decade of compounding growth. Picture the waiting room of a veterinary clinic in suburban Dallas. A millennial couple sits with their French bulldog scrolling through pet insurance options on their phones. They've already spent $3,000 this year on preventive care, diagnostics, and treatments, more than their parents spent on their own health care. This scene, replicated millions of times across developed markets, captures why Zoetis bulls see another decade of exceptional growth ahead. The math behind pet humanization is compelling. In 1990, American pet owners spent $460 annually per dog on veterinary care. By 2024, that figure exceeds $2,000 and continues growing at 8% annually. Penetration of advanced treatments remains low. Only 30% of dogs with osteoarthritis receive treatment. Only 40% of pets are on year-round parasite prevention. As awareness grows and new treatments emerge, spending could double again over the next decade, with Zoetis commanding 25% market share in companion animal therapeutics. This secular growth translates directly to revenue expansion. Innovation leadership provides the second pillar of the bull case. Zoetis' monoclonal antibody platform has already yielded 4 blockbusters: Cytopoint, Librela, Solensia, and the recently approved Boncot for feline inflammatory diseases. The pipeline contains another dozen antibody candidates targeting everything from canine cancer to feline kidney disease. Each successful launch strengthens Zoetis' position as the innovation leader, creating a virtuous cycle where veterinarians look to Zoetis first for breakthrough treatments. The bull case gains strength from competitive dynamics. Elanco, Zoetis' closest competitor, struggles under $5.3 billion in debt from its Bayer acquisition, limiting R&D investment and strategic flexibility. Merck focuses primarily on livestock, ceding companion animal leadership to Zoetis. Smaller players lack the scale to compete in high-investment categories like biologics. This competitive landscape gives Zoetis unusual pricing power and market share gain opportunities. International expansion represents massive untapped potential. China's pet population exceeds 200 million, but annual spending per pet is just $75 versus over $500 in the US. As Chinese pet ownership patterns westernize, moving from guard dogs to companion animals, spending could increase tenfold. India, Brazil, and Southeast Asia offer similar dynamics. Zoetis' early investments in these markets position it to capture disproportionate growth as they develop. The diagnostics platform opens entirely new growth vectors. The global veterinary diagnostics market grows at 10% annually, faster than therapeutics. Zoetis' integrated model, combining diagnostics and therapeutics, creates unique advantages. When a Zoetis diagnostic identifies chronic kidney disease, the company can provide therapeutic solutions. This closed-loop model drives higher customer lifetime value and creates switching costs competitors can't match. Digital transformation multiplies these advantages. Zoetis' digital ecosystem touches 15,000 clinics globally, generating data on treatment patterns, outcomes, and emerging diseases. This data enables precision medicine, tailoring treatments to specific patient populations, and predictive analytics that identify at-risk animals before symptoms appear. While revenue impact is nascent, digital could add 2 to 3% to annual growth, while improving margins through better customer targeting and retention. Emerging therapeutic areas offer step function growth opportunities. Veterinary oncology, virtually non-existent a decade ago, now represents a $500 million market, growing at 20% annually. Regenerative medicine using stem cells and gene therapy could transform treatment of inherited diseases. Mental health pharmaceuticals for anxiety and cognitive dysfunction in pets are gaining acceptance. Zoetis' R&D capabilities and commercial infrastructure position it to dominate these emerging categories. The financial algorithm compelling bulls is simple but powerful. Start with 6 to 8% organic revenue growth driven by volume and price. Add 2 to 3% from bolt-on M&A. Generate 30 to 50 basis points of annual margin expansion through operational leverage. Combined with modest multiple expansion, as the market recognizes Zoetis' quality, bulls see 15% annual returns as achievable. With return on equity at 52.77% and capital allocation discipline, this isn't fantasy. It's extrapolation of current trends. The bear case, structural headwinds and disruption risks. Yet skeptics point to gathering storm clouds. In a recession scenario where unemployment hits 8%, discretionary spending on pets could plummet. The 2008 financial crisis saw veterinary visits decline 15% as pet owners deferred non-emergency care. While pet humanization has strengthened since then, a severe recession would test whether $200 monthly pet medications are truly non-discretionary. With 60% of Zoetis revenue from companion animals, this exposure is material. Generic competition looms larger than bulls acknowledge. While animal health has avoided the patent cliff devastation seen in human pharma, this protection is eroding. The FDA's Generic Animal Drug Act streamlines approval for generic versions of pioneer drugs. Chinese manufacturers are developing biosimilar versions of blockbuster products. As Apoquel's patents expire in 2026, generic competition could erode Zoetis' dermatology franchise, currently generating $800 million annually. Regulatory pressures intensify globally. The European Union's new veterinary medicine regulations restrict antibiotic use in livestock, threatening Zoetis' $400 million livestock antibiotic franchise. U.S. proposals to eliminate over-the-counter antibiotics could similar impact. While Zoetis pivots toward alternatives like vaccines and probiotics, the transition period could pressure revenues and margins. Regulatory compliance costs continue rising, with new pharmacovigilance requirements adding $50 million annually to operating expenses. The livestock segment faces structural challenges beyond regulation. Consolidation among protein producers increases buyer power. The top 4 poultry integrators control 60% of U.S. production. These mega-producers demand volume discounts and play suppliers against each other. Alternative proteins like cultured meat, while still nascent, could disrupt traditional animal agriculture over the next decade. Climate change pressures could force production shifts that strand Zoetis investments in certain geographies. Competition from unexpected quarters threatens the innovation moat. Tech giants like Amazon and Google explore veterinary applications for their AI platforms. Telemedicine companies bypass traditional veterinary channels, potentially disrupting Zoetis' go-to-market model. Direct-to-consumer brands using social media marketing capture share in categories like supplements and nutraceuticals. While Zoetis' regulated products have protection, these disruptors erode the broader ecosystem Zoetis depends upon. Market saturation in developed countries limits growth potential. U.S. pet ownership peaked at 70% of households. There simply aren't many more pets to treat. Veterinary price inflation, running at 8% annually, risks pricing out middle-income pet owners. Pet insurance penetration remains stuck at 3% in the U.S., limiting owners' ability to afford advanced treatments. Without addressing affordability, the industry risks killing the golden goose of pet spending growth. The China opportunity that bulls tout carries significant risks. Regulatory uncertainty persists. Products approved one year might be restricted the next. Local competition intensifies as Chinese companies copy Western products and undercut pricing. Cultural differences mean Western pet care models might not translate directly. And geopolitical tensions could restrict Zoetis' ability to operate or repatriate profits from China, turning the growth engine into a stranded asset. Valuation concerns give bears ammunition. At 25 times forward earnings, Zoetis trades at a premium to both pharma peers and the broader market. This valuation assumes continued high growth and margin expansion. Any disappointment could trigger multiple compression. With interest rates normalizing, high multiple growth stocks face headwinds. A reversion to historical animal health, multiples of 18 to 20 times earnings, implies 20 to 30% downside. The innovation pipeline, while robust, isn't guaranteed to deliver. Monoclonal antibody development costs $100 million per product, with 50% failure rates in late-stage trials. The next generation of products might not match Apoquel's or Simparica's success. R&D productivity across the pharmaceutical industry has declined for decades. Zoetis isn't immune to this trend. Without blockbuster launches, the company can't justify its premium valuation. ESG pressures create additional headwinds. Investors increasingly question the ethics of livestock production and its environmental impact. While Zoetis argues its products make animal agriculture more sustainable, activist investors might pressure allocators to divest animal health stocks entirely. The company's exposure to antibiotics, even for therapeutic use, draws scrutiny from antimicrobial resistance advocates. The verdict: quality at a price. Weighing both cases, Zoetis emerges as a high-quality compounder facing legitimate but manageable risks. The secular growth drivers, pet humanization and protein demand, remain intact despite near-term challenges. The company's execution track record, financial strength, and innovation capabilities provide confidence it can navigate headwinds. But the premium valuation leaves little room for error. For long-term investors, Zoetis represents a bet on humanity's evolving relationship with animals. As societies grow wealthier, they spend more on animal care. This pattern has held across cultures and centuries. Zoetis, as the industry leader, captures a disproportionate share of this spending growth. While the path won't be linear and volatility is certain, the destination seems clear: a larger, more profitable company serving the enduring human-animal bond. The key variables to monitor are straightforward: companion animal procedure growth, international expansion progress, innovation pipeline advancement, and competitive dynamics. If these trend positively, the bull case prevails. If multiple factors deteriorate simultaneously, the bear case gains credibility. But given Zoetis' track record and market position, betting against the company requires believing that fundamental human behaviors will change. A wager history suggests is unwise.
Standing in the executive conference room where it all began, Juan Ramon Alaix, now retired but serving on several boards, reflects on the journey with current CEO Kristen Peck. The walls display artifacts from Zoetis' evolution: the original Pfizer Agriculture Division sign from 1952, the NYSE bell from the 2013 IPO, patent certificates for Apoquel and Cytopoint. But what strikes visitors most is a simple framed quote from Charles Darwin. "It is not the strongest of the species that survives, nor the most intelligent, but the one most responsive to change." This adaptability defines Zoetis' transformation from corporate division to industry leader. The company that began as an accidental discovery in Missouri soil samples evolved through 7 decades within Pfizer, emerged as an independent entity, and then transformed again into something neither Pfizer executives nor IPO investors fully envisioned. A precision animal care company operating at the intersection of biotechnology, data science, and traditional veterinary medicine. The journey offers profound lessons about corporate evolution. Zoetis proves that successful spin-offs require more than financial engineering. They demand cultural transformation, strategic clarity, and exceptional execution. The company's employees didn't just change the logo on their business cards, they fundamentally reimagined what animal health could become. This psychological shift from division of a giant to master of our destiny unlocked innovation and initiative that had been dormant for decades. Consider the key decisions that defined Zoetis' trajectory. The choice to maintain R&D investment at 7 to 8% of revenue when activists pushed for margin expansion. The discipline to pursue bolt-on acquisitions rather than transformative mega deals. The courage to enter new categories like diagnostics and aquaculture despite lacking expertise. The patience to build positions in emerging markets years before they became profitable. Each decision required choosing long-term value creation over short-term optimization. The leadership transitions. From Abaxis' foundational years to PEC's growth acceleration, demonstrate how different stages require different skills. Abaxis, the steady hand who navigated independence, built credibility with investors and established Zoetis' cultural identity. PEC, the growth catalyst, pushed geographic expansion, drove digital transformation, and championed breakthrough innovation. Neither could have succeeded in the other's role at that moment in time. What makes Zoetis' story particularly relevant for other potential spin-offs is its methodical approach to independence. Rather than rushing to differentiate from Pfizer, the company initially maintained continuity while carefully building new capabilities. Only after establishing operational stability did Zoetis pursue aggressive strategies like the Abaxis acquisition or China expansion. This patience, rare in today's quarterly capitalism, proved essential for sustainable success. The broader implications for healthcare convergence are fascinating. Zoetis operates in a unique space where human and animal health intersect. Diseases like diabetes, cancer, and arthritis affect both humans and animals. Treatments developed for humans increasingly translate to veterinary applications and vice versa. Zoetis' monoclonal antibodies, for instance, use the same platform technologies as human biologics, but target animal-specific proteins. This convergence will accelerate as genomic medicine advances. Looking ahead, the next decade promises even more dramatic change. Artificial intelligence will enable prediction of disease outbreaks before symptoms appear. Gene editing could eliminate inherited diseases in breeding populations. Cellular agriculture might complement traditional animal protein production. Digital biomarkers from wearable devices will enable precision medicine for individual animals. Zoetis, with its scale, capabilities, and market position, is uniquely positioned to lead these transformations. Yet, challenges loom. The company must balance growth with profitability as markets mature. It must navigate increasing regulatory complexity without sacrificing innovation. It must address affordability concerns while maintaining premium pricing for breakthrough innovations. It must defend against new competitors while avoiding the complacency that afflicts market leaders. Success is not guaranteed. It must be earned through continued excellence. The financial metrics tell only part of the story. Yes, Zoetis generates $9.3 billion in revenue and $2.3 billion in free cash flow. Yes, it delivers 52.77% return on equity and maintains industry-leading margins. But the real value lies in the company's optionality, the ability to capture opportunities that don't yet exist. When the next pandemic emerges, when gene therapy becomes viable, when artificial intelligence transforms diagnosis, Zoetis will be there. The cultural element deserves final emphasis. Great companies are built by people who believe they're part of something meaningful. Zoetis colleagues don't just sell animal drugs. They enable the human-animal bond, ensure food security, and advance comparative medicine. This sense of purpose attracts talent, drives innovation, and sustains performance through inevitable challenges. It's the intangible asset that doesn't appear on balance sheets but determines long-term success. For investors, Zoetis represents a case study in quality compounding. The company doesn't offer the excitement of disruptive technology or the comfort of deep value. Instead, it provides something rarer, a business with sustainable competitive advantages exposed to secular growth trends, run by competent managers, generating substantial cash flows and reinvesting at high returns. These characteristics, maintained over time, create extraordinary wealth. The Zoetis story also challenges conventional wisdom about scale and focus. Traditional strategy suggests companies must choose between being broadly diversified or narrowly specialized. Zoetis found a third way, focused diversification. The company is laser-focused on animal health, but diversified across species, geographies, and therapeutic areas within that domain. This approach provides both the benefits of specialization, deep expertise and market leadership, and diversification, resilience, and multiple growth drivers. As our conversation concludes, Peck shares her vision for Zoetis' next chapter. We've proven we can operate independently, grow through innovation, and expand globally. Now we must prove we can lead the industry's transformation. The convergence of digital, biological, and data sciences will reshape animal health. Our job is to be the architect of that future, not a victim of it. The sun sets over Parsippany, casting long shadows across the campus that symbolizes Zoetis' independence. Employees heading home carry laptops loaded with research data, sales presentations, and strategic plans. The daily work of building a great company. They're part of something larger than quarterly earnings or stock prices. They're writing the next chapter of a story that began with aureomycin in Brooklyn and continues toward possibilities we can barely imagine. For those studying corporate strategy, Zoetis offers a masterclass in transformation. For those seeking investment opportunities, it presents a compelling combination of growth and quality. For those working in animal health, it provides inspiration for what's possible. And for the millions of animals whose lives are improved by Zoetis' products, it represents hope for healthier, longer, better lives alongside the humans who love them. The Zoetis story isn't finished. In many ways, it's just beginning. The company that emerged from Pfizer's shadow has become a beacon for the animal health industry. Its journey from spinoff to S&P 500 constituent proves that focused execution, strategic patience, and deep customer relationships can create extraordinary value. As the world's relationship with animals continues evolving, Zoetis will be there, innovating, expanding, and nurturing the bonds that define our humanity. This podcast is brought to you by Empor.top, the stories of top companies. Disclaimer: this AI-generated content is for informational purposes only and should not be considered as investment advice.